This is Part B of Chapter 5. In Part B, we'll move from annual payer bonds to semi-annual payers, as well as looking at measuring yields and assessing risk. Remember that the yield to maturity on a bond is quoted as an APR. This allows us to adjust for a semi-annual payer by just dividing the annual YTM by 2 to get the periodic rate. We also have to adjust the years to semi-annual periods and the payment to a semi-annual payment. Remember from Chapter 4, N, IY, and payment must match in terms of time period. This illustrates the adjustments that have to be made to value a bond that is a semi-annual payer. Note that virtually all bonds make semi-annual payments. I call this pricing-specific bonds since you must enter an actual settlement date, the date you buy the bond, and the actual date it will mature. Both your calculator and Excel have functions for this, but for our purposes, we'll stick with using the TVM keys. Please note that you have to have the Analysis Toolpak add-in installed to access the price and yield functions in Excel. If a bond is callable, then the yield to maturity may not be a good estimate of the actual yield. A more accurate estimate may be the yield to call. The valuation method is the same with 2 changes. N is now the number of periods till the first call, and the future value is the call price, including the call premium. Note that this is a semi-annual payer, so when you solve for IY, you get a 6-month yield. You have to double it to get the yield to call. Think of the yield to maturity or the yield to call as the rate you'll earn versus the coupon rate which the issuer is currently paying. So if the issuer can choose between paying 10% or 7.5%, what do you think they'll choose? If a bond is selling above par, then it may be called, so the yield to call is a better estimate of what an investor will earn. At par or at a discount, it's unlikely to be called, so yield to maturity is the best estimate. The required rate of return on debt is made up of the components shown above. R* is the real risk-free rate. It's unobservable, but usually thought to be around 3 to 4%. IP is the expected inflation premium. So R* plus IP is equal to the nominal risk-free rate. This compensates investors for the time value of money, with no risk involved. MRP is the maturity risk premium included on longer-term bonds to compensate investors for tying up their money for a longer time and being exposed to more interest rate risk. DRP is the default risk premium. It's included on corporate bonds but not on treasuries. LP is the liquidity premium, again included on corporate bonds, which do not trade frequently, but not on treasuries, which are very actively traded. The real risk-free rate is unobservable. It assumes no inflation. If an approximation is needed, the rate on Treasury inflation-protected securities, TIPS, provides the best proxy. The nominal risk-free rate is estimated by the real risk-free rate, R*, plus the expected inflation premium. There is no truly risk-free security, but the closest is a short-term Treasury security. For valuing a longer-term asset, the Treasury bond. TIPS are interesting government securities, indexed to inflation, but not quite in the way you'd expect. The coupon rate stays fixed. The principal or face value is adjusted for inflation every 6 months for the life of the bond. The expected inflation premium for security can be approximated by the difference between a non-indexed Treasury and a comparable TIPS. The spread between the required return on a specific class of corporate bond and a comparable maturity Treasury reflects the default risk premium and the liquidity premium. Bond ratings reflect strictly the probability of a default of a bond issue. Companies and municipalities pay to be rated because a higher rating equals a lower coupon rate. Bonds rated below investment grade are frequently termed junk bonds, since they have a higher risk of default and as such pay higher coupons to entice investors. Originally, the only junk bonds were those that started as investment grade and fell on hard times, fallen angels. Along comes the 1980s, Michael Milken, Drexel Burnham Lambert, and the advent of original issue junk, with high risk and high coupons. They were used to fund a lot of acquisitions, LBOs, and takeovers. Though OIJs have declined in popularity, they're still in the market. As of October 2016, this table reflects the yield and the spread between the 10-year Treasuries and various ratings of bonds. As should be expected, as the rating declines, the yield and the spread rise. Bond rating agencies look at many of the same metrics as stock analysts, but with one major difference. Bond ratings are strictly concerned with the default risk, not growth. The rating should reflect the probability that the firm will be able to pay all promised coupons and return the face value at maturity. Stability is prized over growth. This table demonstrates the strength of highly rated firms versus the relative weakness at the lower levels. For example, debt to capital ranges from 12.4 up to 113.5. Besides the financial stability of the company, factors related directly to how the bond issue is structured can affect the rating. Not all bond issues from the same company are rated the same. If a bond issue has physical or financial security, collateral, backing it, the rating may be higher and the coupon rate lower. In the event of default and bankruptcy, senior debt is paid off before subordinated debt. Any guarantee or sinking fund provisions can impact the rating, as can the maturity of the issue. Remember, bondholders have loaned the company money and only want to see the interest paid on time and the principal paid at maturity. Whether the company turns out to be the next Google or not is irrelevant. Stability is more important than growth because bondholders won't share in that growth as equity holders would. Anything that affects earning stability affects the risk of the bond issue. Bonds are exposed to two types of risk. Interest rate risk, sometimes called price risk, is the risk that a bond will lose value as a result of an increase in interest rates. Longer-term bonds are exposed to more price risk than shorter-term ones, since a large portion of the value of the bond is far in the future and will, in the discounting process, be hurt more by an increase in the discount rate. The table on this slide shows a 1-year and 10-year bond and illustrates the effect of price risk. The relationship is shown graphically on this slide. Reinvestment rate risk is the risk that cash flows from a bond will have to be reinvested at current market rates, which are lower than when the bond was purchased. Shorter-term bonds have more reinvestment rate risk, since the face value will be paid sooner. Consider the illustration on the slide. With $500,000 to invest, you can choose a 1-year bond paying 10%. If you lock in a long-term rate and rates increase, you've missed out. But if you opt for a short-term instrument and roll them over every year, you're risking rates declining every year. This pretty well summarizes the trade-off between price risk and reinvestment risk. Long-term bonds, high interest rate risk, low investment rate risk. Short-term bonds, the opposite. Nothing is riskless. Note, as the slide says, the maturity risk premium is more affected by interest rate risk than by investment rate risk. The term structure of interest rates is reflected in the yield curve graph and shows the relationship between short-term and long-term rates. Typically, the yield curve is upward sloping, reflecting both the maturity risk premium and increasing expected inflation. If a firm misses an interest or principal payment on its outstanding bonds, then the bondholders can force the company into bankruptcy. We'll go into bankruptcy more in Chapter 24, but we'll introduce it here. The two main chapters corporations are concerned with are Chapter 11, Reorganization, and Chapter 7, Liquidation. Finally, Chapter 11 stops a firm's creditors from foreclosing or taking the firm's assets while the company develops a reorganization plan. A trustee is typically appointed to supervise, but the firm's management stays in control. If the firm cannot demonstrate that it is worth more alive than dead, the judge will order a Chapter 7 liquidation. This is the bankruptcy claim priority list. Note that secured creditors are near the top, unsecured creditors and stockholders are at the bottom. After seeing the claims priority list, it should be fairly obvious that unsecured creditors and equity holders typically get nothing in a liquidation. Thus, they're more willing to participate in a reorganization plan. Creditors vote on the firm's reorganization plan, and if accepted, the firm emerges from bankruptcy with reduced liabilities. This ends Part B of Chapter 5.